Welcome back to Inside Options. We're talking about Safex Style Options. James, we were talking about margin offsets. Can you quickly recap that
Absolutely.
for us?
So what we've got here are two positions that we've entered into our web-based calculator. You can see there's a call option on 10 contracts for 326 Rand strike on Anglo-American, the September expiry. We can see that if we had that on its own, that red number, that's 16,380. So if you just had that position, you pay 16,380 Rand. Then we've got a future, and we've got 5 contracts. We've gone short of 19,000 margin for that. So we can see that 19,000 plus 16,380 gives us a result of 2,260. That's a margin offset. That's because these two positions sort of cancel each other out, and you're hedged because the move in one will be offset by the move in the other.
Okay, so you'll be able to understand this by playing around on this particular
Yeah, you totally should go and play around with it and see what adding an option or two or adding some futures to your portfolio will do in terms of your efficiency. The alarming thing is if you exit one of these positions, you think, oh, I've got less positions. Suddenly your margin will jump right up from 2,260 to the full 16 or 19,000.
So what else is there about margins that we need to keep
The
in
great
mind?
thing about this is it allows you to have bigger portfolios and to trade more. And we as exchanges, we love it when people trade more. We think that's great. It also is more capital efficient because we're actually looking at it as total risk position. Now the other kind of margin we talk about is variation margin. So that's the change in value of the position each day. So if you bought an option for a premium of 600 Rand, the next day we revalued it was worth 700 Rand, you would receive 100 Rand in cash, variation margin. So this does two things. One is it just cuts out the risk in the system. Each day's losses are paid as they occur. Each day's profits are paid out as they occur. This also makes it fungible because if they're not fungible, then you've got some serious problems. That means that if they're not fungible, you can't swap one for the other. An example would be this.
I was wondering when these are going to come into
Now I've got an apple
Yes.
and an Archie. They're not fungible. Now, two positions with different amounts of outstanding debt, these wouldn't be fungible either. That's the problem with a lot of OTC products, over-the-counter, sort of the trade bilaterally between the big banks. You can't swap one counterparty for another. It's not standardized.
Okay.
So it's binding to that one party. Kind of like a CFD market. If you go to one provider, you can't switch out that position with another provider. You're kind of locked in for that contract till you exit it.
And this is to encourage you to pay off your debts as quickly as possible.
And makes them fungible. So you paid off your debts as quickly as possible, limiting the risk in the system, and you made it fungible. So that's how margining works. Now, a deep in the money option, what's going to happen is it's going to be the same as a futures margin. We can see here that we've got a call, margin for that is 3,800. We've got a future, margin for that is 3,800. Why are they exactly the same? Because this has a delta of 1. Its strike is 100. It's basically a futures contract. It's going to expire deep in the money, and it's going to move exactly in line with the futures contract. So because of that, we're going to charge you the same margin as that. Now the issue is with an option, its initial margin changes each day. It changes each day based on the change in delta. How much risk is on the table? The more risk there is, the more we're going to pay you. Now you've got to remember when you've bought an option that the more your delta increases, the more profits you're getting in. So that's a good thing. You want that to happen. You want it to go to Delta 1. It means you made the right trade and it's moving rapidly into the money. It's moving way past it. It looks like it's going to be very profitable. So as that happens, some of those profits will be held back because that position is now more risky. So that's what we do on a daily basis is recalculate these margins. And it's just a more efficient way of doing it.
All right. How do you, a simple question here, if you're doing this as a trader, can you do this online? How do you actually monitor what you recalculate, what the JSE is calculating every day?
You can do it with this absolute tool we've got here, and you can see what happens on your margin account by adding new positions and testing them out and seeing what happens under extreme circumstances.
All right, so it does take a lot of focus
It does take
and attention.
some focus and attention. You've got to pay attention to it and keep watching what's happening to your margin. Also, don't want to trade something if, say, trade lots of options on something if you wouldn't have the futures margin for them. I mean, you're starting to get into deep risky territory, sort of wagering more than you can afford. But you've got to remember with your option, you're never going to pay more than the premium. That's the worst case scenario, is if you lose money, your premium will just accelerate faster, down to zero, you'll pay your theta off quicker, and that's how the option money actually flows. It's the theta expiring. So we revalue that option each day, gets less and less in value. Because of that, you have to pay the writer of the option that money each day that gets lost.
And just a quick note here, when we're talking about theta and we're talking about gamma and delta in previous episodes,
we have covered that in previous episodes. So you can go to the Summit website or the JSE website and see those.
To get a full understanding of
Exactly.
them. Right. More examples?
Yeah. So this is theta expiring. Now, that is the premium getting paid as theta expires over the life of the option. It goes down and down and down, and then it kind of rapidly accelerates. So it's kind of just like a future in that you're paying interest. In this case, you're paying a premium. You don't pay it all up front. You agree to pay it. That number is set and locked in, and over the life of that option, you're going to pay it across to the writer of that option with that sort of big fall towards the end. Now, what's actually happened quite a few times we've seen is that the option moves into the money so fast that you just keep getting cash out rather than having to pay in. But over time, it will all work out and square out that you pay the premium you agreed to pay.
All right.
So what some of our guys do is, this is quite a fun picture. That's Lehman Brothers with guys walking out with their belongings as Lehman Brothers collapsed in late 2008. In 2008, Lehman Brothers actually were one of the biggest traders of options in the South African market, and indeed in many markets around the world. Because of our way of managing the risk, the clearinghouse could take over their positions, the options they'd written, and they kept receiving cash flow on a daily basis as the theta expired, which gave them the cash to manage those risks, manage those positions of unfunded options. They were continually funded as the theta got paid across by the counterparties. So the issue is, in some of the markets overseas, sort of, I think one of the ones we heard about was maybe Greece, Poland, sort of other emerging markets. They had some serious issues there where premium was paid up front, the premium was then taken, used for other stuff, unfunded option positions taken on by the clearinghouse, lots of people took on losses. In our market, it was seamless, no one made any big losses that they shouldn't have made, and we managed it very, very effectively, caused barely a ripple, and they were a big position holder. So it once again showed us that these Safex style options, where it's margined on a future, margined like a future, are actually really, really great when it comes to managing the risk.
James, just a quick question on costs, if you don't mind. What does it actually cost to go this route?
It's actually pretty frictionless because your fees are all included in your trading fee, which at the moment for an index is 1/10 of 1 basis point times by the delta of the option. And for a single stock future, it is 1 basis point times by the delta of that option.
All right.
So I don't know what sort of markups get passed along on the way, because you have to pay the exchange and then you have to pay a clearing fee and you'd have to pay your broker. So we'll find out in another episode exactly what the going rates are at the moment in some different brokerages.
But generally speaking, Safex style options are, you reckon, a safer way to go?
Absolutely. They offer several advantages. One of the biggest ones is we found in 2008 in a meltdown, a Safex style or pure future style option is far safer. No unfunded liabilities get passed on to the clearer. The other thing is you can list it on something where there isn't a liquid underlying spot market, but there is a liquid futures market. So stock indices, maize, commodities, all these sort of things isn't much of a spot market. There's a liquid futures market. These options are ideal for that. Also, they offer a lot more leverage because you don't have to pay that full premium up front. So if you're paying half the premium, we saw you get about 10 times gearing on some of these options, 20 times gearing because you only have to put in half the premium today.
We'll have to leave it there. We're out of time. James, thanks very much for joining us. That was James Boardman from the JSE's Equities Derivatives Division. We'll be back next time with Inside Options. Goodbye.
Inside Options was brought to you by the Johannesburg Stock Exchange. Manage your risks with Safex Style Options.